Welcome to TheoTrade. This is Don Kaufman. It's October 14th, 2019, and you are watching the TheoTrade evening video. Well, we've got the U.S. bond markets closed for the holiday session. Though the equity markets and index markets are still open, there's just no liquidity. There's no volume out there to really trade upon. The S&Ps, with about 10 minutes to go in the session, are down about 5. But people, this is what I call a veritable slop fest. Slop fest, of course, is, look at the advanced decline line over here, half up, half down. The S&P is not doing much. By the way, in terms of volume, oh, come on, you're way shy of 1 million S&P contracts today. So today, you kind of get a little bit of a do-over. But on that note, we're going to be kicking off kind of in high gear in the next 2 trading sessions, earnings. So why not? Let's take some time to kind of gear up for what to expect as really earnings season, approaches. A couple of the big earnings, all right, that we're going to get right up front. We typically do. The banks. So what's coming out? Goldman Sachs. All right. Stop right there for a second. So Goldman Sachs, when is it going to be out? Well, I'm actually going to kind of zoom out here on the chart. Goldman Sachs will actually be out tomorrow morning. That is Tuesday morning before market. But it's not the only financial that's going to release. We could look at Citi, the exact same situation, releasing before the bell tomorrow. Last but definitely not least, the biggest of them all, JP Morgan, releasing before the bell. And that's going to kick off kind of the tone for the banks around earnings season. But the reason that I'm talking about what to kind of expect in earnings season approaches, people, this is not so much about the numbers like, oh, what's JP Morgan going to say? What's Jamie Dimon going to say in the conference call? Push all of that aside. I use this time to explain that a lot of the apprehension, a lot of the volatility that's going to be in these earnings, okay, is really kind of designated right over here on the right-hand side of the trade tab of thinkorswim. And it's all kind of baked in to the expected moves, which I want to elaborate upon for just a moment. Again, when you're kind of gearing up for earnings, all right, time is best spent not necessarily here in the chart, because does it really matter what those numbers are going to be? If they beat, stock might trade higher. If they miss, stock's going to trade lower. Okay, but by what amount? Now I want to close up this left side bar and I want to explore this in a little bit more depth. Over here on the right-hand side of the screen is what we term expected move. That expected move is derived, okay, by basically averaging the implied volatilities, all right, within a given option chain. I'm highlighting delta here, but you get what I'm saying. If you took a look at the option prices in this particular chain, and when I say the chain, I'm looking right now at with 4 days remaining to expiration. They're pricing right now about a $3.40 some odd cent move, okay, on the JP Morgan earnings. Okay. Now, of course, everybody asks, will that come to fruition? I'm going to discuss that here momentarily. But what you have to read into about this is that that's not you or me saying that JP Morgan is supposed to move $3.44. That's the marketplace. And what's the market? Okay, it's literally tens of thousands of option contracts trading, okay, at these prices to be able to drive kind of the line on movement. So what do we expect out of JP Morgan? Yeah, about a $3.40 move. But other things can also be determined from here by looking, for example, at this implied volatility. Okay, compare the implied volatility for the next 4 sessions, all right, in JP Morgan, which is about a 32% implied vol. Compare that, for example, okay, to Netflix. Why am I comparing it to Netflix? Because Netflix also is going to have an earnings announcement. Netflix, well, it's a little higher than JP Morgan. It's sitting at about 106% IV. So you can immediately discern that, hey, people are way more apprehensive about what's going to go on in Netflix than they are in something like JP Morgan. In fact, if you look at most of the banking stocks, even Go look at Goldman Sachs. Goldman Sachs over here, about a 39 vol, slightly higher than JP Morgan. Go take a look over at like Citi. Okay, it's a party. Citi, a little bit higher over here, maybe a $2 expected move. But what I'm trying to get you capable of doing is by looking at the implied volatility, you can discern risk, all right, on a scale that's universal. You can say, well, the risk in Citi versus the risk in Netflix versus the risk in Goldman Sachs versus, hey, you know what's also coming out? I think this is tomorrow after the bell, and that would be IBM. Okay, IBM. Well, the risk in IBM is not nearly as high as Netflix, but it's definitely higher than some of the banking stocks. Move forward that way. Okay, recognize what your risk is getting in here. Now, let's actually cruise back over to JP Morgan for just a minute. Okay, so upon JP Morgan coming out, the marketplace really isn't anticipating a whole lot of action, a whole lot of movement. Now, of course, people are going to ask, well, what's the effectiveness of this? And you can see that the implied moves, they're going to move around a little bit because as more information comes into the marketplace, okay, traders are actually disseminating that information in real time. So if you look at something like an expected move, all right, and I just want to show you this because it's interesting to see this. There's 4 minutes left to the close. You can't trade this option, okay, tonight, and you can't trade the option tomorrow before the market opens. So all of that, like, again, if you're apprehensive right now, the marketplace is going to come in and they're going to buy a ton of options. If they buy options, it's actually going to send the implied volatility higher. If it sends the implied volatility higher, the expected move moves up. Okay, now these expected moves are extraordinarily effective around earnings. See, everybody's always trying to kind of handicap things about earnings, and I want to explain something a little bit more detail with that. We'll jump over, okay, and back to Netflix. Now, over the next few weeks, you'll see me take earnings and earnings related trades. I mean, we're even going to do an entire class specifically on earnings, okay, this coming Saturday. So on Saturday, which is going to be October 19th, there's an entire class that's going to surround, for instance, these expected moves and taking that expected move, okay, not just being able to derive it, being able to turn that into a physical trade. Okay, with a decent probability of success and a high payout. But before I get to that particular class, again, it's so important to understand the concept of, listen, when it pertains to earnings announcements, newer traders, they get misled constantly, okay, down this road that earnings must have some edge in them. I mean, look, there's 100% implied volatility. And when people see high implied volatility or what they interpret to be high implied volatility, they immediately, okay, think to themselves, wow, that's a lot of volatility. I might want to sell, okay, those options. Absolutely, unequivocally, no. Don't do it, especially not in Netflix. Netflix, this thing is known as the widow maker for people that sell options, especially those that sell options naked in here, right? I can't stress this enough. That implied volatility, okay, is going to continue to go up, all right, as we approach the earnings. And again, Netflix doesn't even have earnings until I think it's Wednesday after the bell. So that implied volatility might reach 130, 140%. Because what's going on, right? People think that the risk is going up. So look at this number. That number right there, okay, I promise you is going to go up, okay, in the next couple of days. Why is it going up? See, what's happening, okay, in the last couple of days before an earnings is that what? Time is moving forward. So time is always going forward. So people assume that these options, as you move through time, options do what? You assume that they decay, okay? So if I drew like a decay graph, right, and a typical decay graph, and I'm actually going to try to script this a little bit better for you. But if I drew a decay graph, like here's an option trading for $13. So your $13, you assume over the next 4 days is going to decay like that and eventually goes down to zero, like exponential decay. This could not be any further from the truth. The option itself will actually stop decaying altogether. In fact, sometimes will go up in value, but the decay graph would look something more like this. Here's your $13 option. Okay, the option will go like this, and then the second that the earnings come out, the decay, all right, all drops out at one time. Now, again, you'll look at this and you'll think, wow, that's really advantageous though. I can sell 105% implied volatility. but you're not really selling high implied volatility. What you're selling yourself into is a position where the stock is expected to move precisely what the implied volatility says it's supposed to move, meaning that it doesn't matter, okay? It doesn't matter per se that this is high implied volatility. That volatility is high because the stock is going to move $27, meaning that the entire move is priced in, regardless of whatever you think. Okay, so as that implied volatility gets jacked up around the earnings, people are always looking for like some edge. You know, one of the other edges that they try to find, by the way, this is all stuff that you need to be aware. They'll try to sell 105% implied volatility, and then they'll turn around, okay, and they'll buy 73% implied volatility. Well, that doesn't work either, right? So I like to go through earnings, and I like to tell you, hey, a lot of the stuff that you hear about earnings, it's all garbage. It's not true. Now, why? Okay, if you sell high implied volatility and buy low implied volatility, that should work. Yeah, but you're missing one of the biggest points. There's the closing bell. You're missing one of the biggest points. And that point has everything to do with what's termed Vega. Vega is an options sensitivity to changes in implied volatility. Now, do we agree that when the earnings come out, the earnings, right there, the earnings are going to come out. We have to agree that the implied volatility right after the earnings is going to go, it's going to drop. Okay, and as it drops, okay, all of the extrinsic value, that's the time value in here, is going to come sucking out of these options. The only problem with that is, yes, you sold these options, but you also turned around and bought these options, or bought options even further out in time. And I'm going to give you a little bit more of a longer term example. Okay. See, the issue pertains to the fact that options further out in time, and in this case, okay, I am comparing options with 4 days remaining versus options with 32 days remaining, just to overemphasize this. Look, options with more time, okay, have more volatility, meaning that their Vega component is extraordinarily large. Like if you take a look, 32 days from now versus 4 days from now, 32 days from now, there's almost 3 times as much Vega risk. And you're like, what? What that means is when the earnings come out, yes, indeed, this volatility will drop, but these volatilities will also drop. Not as much, but they will. How low are they going to drop? You know, that 52% will drop in line, okay, with some of these back month options. That 52% may drop all the way down, okay, to let's say 41%. So it loses, for example, okay, 11 volatility points, but it's 11 volatility points times whatever that Vega is. But in this case, it's 34 cents. Now, these volatilities will also drop, okay? How low are they going to go? Well, they'll drop, they'll get crushed. But again, it's less than you would believe because the Vega component, this Vega component, right before the earnings come out, this Vega is going to be negligible. That Vega component is going to drop even more. So what you get is you think that you're taking advantage of volatility. Okay, it's anything but the truth. Okay, again, if you start comparing Vega from one expiration cycle to the other, you're going to realize that when the volatility drops from 105 down to 50, okay, that's the same thing as your 70 vol dropping down to 40. And you're like, what? It is. And that's the thing that really misleads so many newer traders around earnings. Listen, okay, as this week progresses, you know, I will explore trades specifically in Netflix. And the next time I'm going to do a video is not till Wednesday, right when Netflix is coming out with earnings. It's all right, okay? Because what you're going to learn about earnings is that there's only a few avenues that you can take, okay? You can get bullish, you can get bearish, or you can go after the expected moves. And that's precisely, okay, what we intend to do in the class that comes up this October 19th is we're actually going to trade, okay, to pinpoint the expected move on, okay, any given underlying around the earnings. Again, a lot of earnings coming out. But as I always caution people, it's not what you think, right? The earnings are a very efficient time for markets. Just after the close, the S&P's down 6 in this holiday trading session. Expect more volatility as this week picks up and earnings season kicks off. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.